Hi everyone, welcome to my channel FRM Unplugged. As promised last time, I am back with another episode of the FRM case study series, and today we will be talking about the case study involving the big FMCG giant Procter Gamble. So, as we all know, Procter Gamble is a worldwide leader in FMCG, and this case pertains to in 1994, which is close to 3 decades back. So they were at that point of time they were having an annual sales of more than $30 billion, which is a large amount, and they entered into some derivative transaction with a bank by the name Bankers Trust. Now, Bankers Trust was a bank which was formed out of amalgamation of many banks in 1900 to 1903. So they started out with giving their so-called trust services, and they eventually also ventured into commercial lending, and that is where they came in contact with Procter and Gamble, and eventually the deal happened. So Procter and Gamble was looking at ways to reduce their fixed cost of their debts. They were carrying certain amount of loan in their balance sheet, and if truth be told, they were interested in putting a stop or in limiting their losses due to rises in interest rates, because they had a fixed component of loans. So the purpose was not for speculation, it was for hedging. However, the Bankers Trust, probably, as we will see in details, they maybe kind of sold a slightly complicated product which was not required, which defied the conventional laws of finance, and Procter and Gamble entered into an interest rate swaps. So interest rate swaps, as we all know, it's like they swapped their fixed rate with a floating rate, and eventually they had to prematurely close two of their interest rate swaps. And as we all know, there is a cost of unwinding, and this cost translated to approximately $135 million. So $135 million loss or a capital charge in face of 100 in the face of $30 billion turnover is not a large amount. But the question was of trust; it was not of the amount. So Procter and Gamble took them to court, alleging that there was a criminal breach of trust, and that they were not properly explained the pitfalls or the dangers of the deal. And eventually the court had to intervene, and the claim amount was whittled down from 135 to around $50 million, which Procter and Gamble had to pay. So, without further ado, let's straight away dive into the facts of the case. Following are the facts of the case. Basically, Procter and Gamble is a worldwide leader in FMCG goods, and they were formed. I think the company originated in 1837 or 1840 types, and it's currently ranked in 54th or 50 or maybe 60th rank in the Forbes list. So it's a pretty big company. It's based out of Cincinnati, US, and it operates in maybe more than 100 companies, 100 countries in the world. And it had some $100 million of loan in its books. It wanted to hedge against interest rate risks, and it wanted to kind of reduce its interest cost, which means it wanted to profit from uh, reducing interest rates. And for that, it entered into an interest rate swap with their bankers, which is Bankers Trust, and it was a big bank at that point of time in US. And basically, it had the swap had three components. One was the plain vanilla swap, one was the speculative swap, and the third one was on the Deutsche Mark. So we will not deal in the Deutsche Mark because it's not a separate thing. The idea behind the case study is suitably explained by the first two products that it took from BT. So we will just delve on the first two products. And by 1994, Procter and Gamble had incurred losses, and as usually happens, customers will refuse to pay. So PNG was no exception, and additionally, it took BT to court. Usually, in these kind of cases, the customers will always take the legal route, and it will put forth their agenda that they were missold the product and there was no proper communication, and BT had hidden certain information or had suppressed some information and all that. So the script was very, what should I say, forecastable, and eventually the courts also, in most of the cases, takes a lenient view in favor of the customer, and in this case also the same thing happened, and PNG was not did not pay the full amount, and eventually bankers trust lost goodwill, lost the confidence, it had some issues, and then it had to be taken over by Deutsche Bank. Now, the basic swap structure. So, swap is basically you are exchanging the cash flow. You don't exchange the principal, you only exchange the cash flow. And the underlying agenda motivation for swap is, so like for in stock markets, the buyer and seller have different perspectives on the share price. Here, the two participants of the swap, they have contrasting views. So one party may have a view will have a view that the interest rates will decline, and another party will bet for rising rates, and they will come together via a third party, or let's say intermediary, which is like a usually an investment bank. And so these two parties will not know each other's existence. They will only deal with the bank, and the entire dots will be joined by the bank. So it will be one full transaction between party A and party B via bank, bank, let's say XYZ. And A will not know that it's actually dealing with B, because A is dealing is with the bank. Just like we had for the counterparties, no, in futures exchanges. Same thing happens here. Just to illustrate, let's say there are two companies. For the sake of our brevity and our discussion, we will say two companies are there. One is AAA, one is triple B, based on their credit rating. Now, AAA they have some, let's say, loan from a bank. So they will have a fixed rate loan and a variable rate loan. So for our example, just take that it has a fixed rate loan at 10.8%, a variable rate loan at, let's say, LIBOR plus 0.25%. So LIBOR is no more in vogue. So, but just for the sake of our discussion, let's take LIBOR only. LIBOR has been phased out as of now. So it has 10.8 and LIBOR plus 0.25. And the triple B has a fixed rate from bank for 12%, and the floating rate loan is at, let's say, LIBOR plus 75 basis points. Since this is triple B, it has the credit spread is more, so triple B pays more to the bank than triple A. I think this much is pretty evident. So if you see, the triple A company has absolute advantage in both the fixed and variable, but in terms of comparative advantage, A has comparative advantage in the fixed loan and B has comparative advantage in the variable loan, simply because the difference in variable loan is 50 basis point, and the difference in and the difference in fixed loan is 1.2%. So what A will desire for a floating rate loan, and B will desire for a fixed rate loan. Additionally, this deal is also aided by the fact that since A has a fixed rate loan from the bank, A will potentially miss out on getting some additional benefits when rates decline. So that is also another reason A will require a floating rate loan. And similarly, B already has a float. So A has a fixed loan because A, just we saw, has comparative advantage in fixed loans. So B has a, since B has a comparative advantage in floating rate loans, it will take floating rate loan from the bank, which is at LIBOR plus 75 basis point. And unlike A was missing out on the extra juice when rates reduced. B would be thinking that I can get caught, or I may have to withstand the additional amount in cases LIBOR increases, which means if there is an overall increase in rates. So that is the reason B would like to have a fixed rate loan, because once you have a fixed rate loan, even if rate rises, you are unscathed. You escape unscathed. So these two are the guiding thoughts behind swap. And what they will do is they will have a transaction through the bank wherein B will, let's say, take, like we discussed, LIBOR plus 75 basis points, and it will pay a fixed loan of fixed interest rate of 11% to the bank. And bank will keep 0.2% with itself, and bank will pass on the rest 10.8% to AAA, who has already taken a loan at 10.8% from its bank. So AAA is receiving 10.8% from the bank, and it is paying 10.8% to its funding bank. So this bank and this bank are separate. So AAA is paying 10.8%, and additionally AAA also is paying LIBOR back to the bank, and bank is passing on the same LIBOR to BBB. So why is this circuitous transaction happening? So that the answer to this question is, this will eventually result in net savings for all the three parties, A, B, and the bank. So it's basically a win-win situation. How? So if we look at the payoff for A, it is receiving 10.8, it is giving 10.8, and it is paying LIBOR to the bank. So net borrowing cost to A is L. Whereas had it now, and this is a floating rate, it's receiving fixed, giving fixed, and it's paying LIBOR. So A has eventually converted his fixed rate loan into a variable rate loan, and the net cost is L. And so had it without this swap, it would have had to dish out LIBOR plus 0.25 to the bank. But after the swap, it is only having to pay LIBOR. So 0.25% is a cool money for this guy, AAA. Now coming to BBB, it is receiving LIBOR from the bank, and it is paying LIBOR plus 75 basis points to its funding bank. So again, these two banks are separate. So and BBB is also paying 11% back to the bank. 11% is fixed. So BBB wanted a fixed funding. So now we'll see. So it has now BBB is receiving LIBOR, and it's paying LIBOR plus 75 basis point. So it does not. So it is no more exposed to the winds of interest rate increase, because whatever the LIBOR increase, even if LIBOR increases by 5%, so his payment to its funding banker also increases by 5%, and he is also getting that much from the swap bank. So net he is protected. Additionally, he is paying 11% to the bank. So his net borrowing cost, if we see, it is 11.75%. Again, without this swap, the B would have had to pay 12% to its funding bank, which means for B also it's a cool 0.25% straight away in his pocket. So till now, both A and B have won in this deal. Now we'll see what the bank has to do. Payoff for the bank is also, it's paying 10.8%, receiving 11%, and it is whatever it's receiving as LIBOR from A, it's paying off to B. So net it's only pocketing 0.2% without any additional exposure. So its exposure to A is hedged by the its transaction with B, with the result that it's pocketing 0.2%. So if in effect all the three parties are gaining from the swap transaction. This is how this is a very basic swap, and this is called the plain vanilla swap. From the liability perspective, so this let's say a bank which has a fixed rate loans and it has variable rate liabilities. If rates increase, these guys can't increase the rates on the loans, whereas these guys have to increase the payouts to the savings account or the CD holders, which will squeeze the margins of this bank. So they will try to use IRS to hedge this interest rate risks. So this is one of the use cases. Similarly, from an investment perspective also, this IRS can be used to hedge against interest rate risk for the investment portfolio. So these two use cases are not very much relevant for the PNG case. Nonetheless, these are important use cases, so it was worthwhile to mention here, and so I mentioned it. Now coming to the genesis of this swap, just keep in mind that Procter and Gamble had a $100 million loan. So usually, very big corporates, they would, when they need funds, they will approach banks, and sometimes they need not approach banks. They will just approach some investment banks who will do some bond underwriting, and they will issue bonds, and they will take money from the public. So they had $100 million in bonds, and which carried a fixed interest with a 6-year or 5-year maturity, and it carried a fixed interest rate of 5.3%. Now 5.3% was the payout that they were supposed to, it was the promised payout, like it happens in a bond. So what if the rates decreased? PNG would stand to lose, right? So one way of dealing with it was to recall that bond. We all know what a bond with a callable option is, where the issuer can recall the bond at any point of time. But again, this is a administrative hassle, and it has some legal ramifications. So what the another tool at the disposal of these corporates are the interest rate swaps, which will take care of this kind of scenarios, right? So what usually will happen is they will approach any investment banker, and they will say that, hey, look, I have a fixed commitment of 5.3%, whatever is the interest rate that they have to pay, and I fear that rates can come down and I stand to lose. So can you do you have a product? So they will say, of course we do have, and this is how it will work. And just the way I explained in my previous slide, there will be some payout from the bank to the Procter and Gamble, and Procter and Gamble would also have to pay a certain amount to the bank. And if you do a net payoff, the in cases of rate increase, nothing happens. In case of rate decrease, there is a this guy stands to gain, and his interest the interest rate risk is mitigated. Now here that's what we have mentioned here. The next 5 years, BT, like I mentioned, like 10.8% in our last example we saw. Same thing here, it will receive 5.3% and pay 5.3% to the bondholders, and then PNG agrees to pay to BT any reference. So in our earlier example, it was linked to LIBOR. In this example, in the case of Procter and Gamble, it would be linked to the commercial paper rate, whatever is the commercial paper rate prevailing at that point of time. Now, again, so that was one leg of the swap transaction, and just like this, the second portion was uh, it was just for our example. Keep in mind that Procter and Gamble is the triple A. Now there should be a triple B also for the bank. So here the intermediary bank was Bankers Trust. So usually Bankers Trust would find a customer, and let's say in this example it's like Unilever, and it will get some addition. So it has to pay 5.3. So always keep in mind, banks or the counterparties, they don't have control on the variable reference rates. It could be commercial paper or LIBOR. So they will try to make some. So banks will try to make some money in the fixed rate. So if the bank has to pay 5.3% to PNG, it will try to take 5.35% or 5.4% from Unilever. And since Bankers Trust is asking for a CP linked rate from PNG, it will pass on the same CP linked rate to Unilever, so that the net payout to BT is 5.35 minus 5.3 or 5.4 minus 5.3, whatever. So that is the net payout to the BT, and PNG is they pocket some additional amounts, additional interest rates in the entire transaction, and it effectively converts its fixed rate liability of 5.3% into CP linked rate, which means fixed is getting converted to variable, just similar to the way we just discussed. Just the same thing is happening here. One additional thing what has happened here is, for this is where the crux of the case comes in. So they, for reasons best known to BT and PNG, maybe they tried to sweeten the deal by, or maybe they failed to explain the full thing. So they also added a speculative bet. One was the plain vanilla IRS, and one was the speculative bet, which basically was, so plain vanilla IRS, we are all clear. On the speculative bet, what had happened is, they entered the deal in, let's say, November 93. So, and the deal was for 5 years. So what BT said is, today we are doing a transaction with you. After 6 months, what we will do is, we will calculate the spread. So what is the spreads formula? This is the spreads formula, which is maximum of 0 or 98.5 times whatever. This 5-year US Treasury note minus the price of 30-year US Treasury bond by 5.78% by 100, whatever. Now, the basic, so this is undoubtedly a complicated formula, but if we look at it on the first sight, we can say that this spread is getting magnified by 98.5 times, which is a huge amount. So PNG stood to lose a huge amount in case the spread was more than 0. If the spread was 0 or less than 0, then there was no payoff. Effectively, this meant that PNG was assuming the role of a seller of a put option in shares. What we know, the seller of a put option expects the price to come down, right? And in case the price increases, then the seller of the put is forced to buy the shares at the increased prices, which results in unlimited loss for the put seller. However, if prices decline, then the option buyer doesn't exercise the option, and the put seller simply pockets the premium. That's the plain rule, working of a put option that we know. The seller of the put option stands to gain if price declines, and vice versa. So here the price of the share price is just it's just for our discussions. In this particular case, it was the interest rates. So the speculative bet was, PNG would receive from BT 0.75% per year, right? And on a notional amount of 200 million, and this PNG would receive. Obviously, PNG has to pay also. How much it has to pay? Based on the custom made formula, and that much percent of 200 million they would have to pay every 6 months. So at the outset, nothing happens for the speculative bid. After 6 months, we determine what is the rate, we determine what is the spread, and that spread we apply on $200 million, and then that much amount is so that spread we calculate the spread for the 6 months, and every 6 months PNG would need to pay this much to the to Bankers Trust. So, now, if we see here the speculative bet, right? Now, if we look at this this graph, right? This I think this is a pretty familiar graph for the seller of a put option. So all this while till the till the break-even point, right? This where the spread is 0.75%. So till the time that the spread, the difference of the 5-year rate and the 30-year, that complicated formula, till the time the spread was up to 0.75%, there was no payment from PNG to BT. Only beyond this point would the payment start, and if you see here, there are unlimited losses based on the spread value. If the spread is very huge, then there is a very huge loss to to PNG. That is what this graph represents. Till now, at the time of November, right? If you see here, in November 93, the spread was minus 17%, and when the BT recalculated the spread as per the terms of the agreement, it turned out to be 27.5%, because first is, how can this much be increased? Reason was that 98.5 multiplicative factor, as also the interest rates were increased by Mr. Alan Greenspan, who was the Fed governor at that point, Fed chairman at that point of time, and probably the rates had increased by around 4 to 4.5%. Increase in rates was magnified by that 98.5 multiplier, and that proved to be the undoing. So if you see here in this graph, there was a big flat area where PNG was in a very safe zone, because in November it was at minus 17%, and till here, till this break-even point, it had a large safe buffer zone where it did not have to pay anything, and on the contrary, it could pocket the 0.75% premium. But that was not to be. Interest rate increased, and correspondingly the multiplicative factor made the losses even worse. So once the rate increased, what happened to the plain vanilla swap? We will not go into the very intricacies of a swap valuation, obviously, since it's not in the scope of this case study, but just keep in mind that anything that we value in finance, in corporate finance, can be broken down into the present value of the future cash flow. So when the rates were 5.3%, the initial thing was, I'm talking now about the first one, the plain vanilla swap. I'm not coming to, after that we will come to the speculative bet losses. Now we are in the first loss, which is the plain vanilla swap. So the plain vanilla interest rate swap was calculated at 5.3%. Now rates had increased to some 7%, or let's say 8%. So
when the rates increase but your payout is fixed, what happens to the present value? The present value declines, right? So I think this is very basic mathematics, right? Because you are increasing the rate, but you are not increasing the future cash flow. So obviously, then this present value has to decline, right? So that's what happened here. The present value declined by around 9 million, which is not a very big amount compared to the speculative side thing. So the losses on the plain vanilla interest rate swap was around 8 to 10 million, which is solely on account of the way I just explained. So because 5.3% was the payout every 6 months. So what we are doing is we are calculating the discount factor, and then we are multiplying the discount factor with the notional amount, and then we are finding out the total. So initially, let's say every 6 months or every 12 months, let's say it was $200 million was the swap value, $100 million was the swap value. Now it is, let's say, $109 million kind of thing. So there was a some loss in the interest plain vanilla interest rate swap. Now we are coming to the second product, which is the speculative bet. Now for the speculative bet, what we are seeing that from minus 17% to 0.75%, there was no profit, no loss, and beyond 0.75%, there was a unlimited loss. But just one smart thing which PNG did was, in the interim they renegotiated, and that 0.75% that this BT was supposed to pay to PNG, they renegotiated it to 0.88%, and they also capped the spread to 15%, which means in a put from a put seller's perspective, the losses are unlimited, but here it is not unlimited, it is capped up to 15%. So eventually, PNG would receive 0.88% and PNG would pay 15% at most. So the interest rate increased to such an extent that the spread was much more than 15%. However, since they had renegotiated it, the spread was capped at 15% and it had to pay 0.88%. So in net, PNG had to pay 14.12%. So when it had to pay 14.12%, the amount that PNG was supposed to pay to BT every 6 months was a very large amount, and it was around, if we do the calculation, it comes to, the present value comes to around $105 million. So at the outset of the any swap transaction, the value of the swap is zero. At some point of time, when the cash flows are fixed, you know what are the cash flows, then you can calculate the value of the swap, and as per that value of the swap, from a BT's perspective, the value of the swap was $105 million. And just imagine, the agenda of PNG was to save 0.4% on $100 million, which is $400,000 was the agenda was the amount that they wanted to save. And they went into such a complicated product that instead of saving 400,000, which is $0.4 million, they had to pay $105 million to Bankers Trust. So this was, astonishing is an understatement for this. We don't know what's the correct adjective to describe this, but that's what it is. So it was a highly complex and leveraged swap that this guy's BT had sold to PNG, and to be honest to BT, PNG always, to the best of our understanding, they understood, and maybe they could not appreciate the risk, but see, we can only speculate. We don't know what actually happened, but going by, I mean, BT would also have done its due diligence. It would also have given disclaimers and guidance and all necessary things. But it may not have. It may have suppressed some information. But in the end, this is what happened. $105 million was the net outstanding of PNG to Bankers Trust. So obviously, I mean, we all know any company would not pay that much amount, and they took them to court, and eventually court had to act on it, and uh, luck was on PG's side, PNG's side, and it ruled in their favor only. And subsequently, BT also had some issue with one more company, some greetings card company. I'm not getting the name now. So similar kind of a deal was struck with that greetings company also, and that company also faced the same fortune as PNG, and that company also took BT to court. So that also made the case stronger for PNG, that PNG was not lying to the court. There were similar cases for other customers also. And if we look at the lessons learned, again, so all the derivative debacles, if we see, if you are only, see, these derivatives are called as weapons of mass destruction by a savvy investor no less than the founder of Berkshire Hathaway. So it's not actually a weapon of mass destruction. So long as you are using it for hedging purpose, you are fine. But the moment you use it for speculating and making money, you should also be prepared to bear the brunt of it. Another useful terminology, and we will cover it in a different section, is the value at risk. Value at risk is a very important concept in the world of corporate finance. It gives an indicator. It's a quantitative measure. It tells the probability of how much a company will lose, minimum amount the company will lose at some degree of confidence. So had these guys used the VAR methodology, we call it VAR for in our terminal, in our day-to-day conversations. So had they used the VAR methodology, the corporate treasurers at PNG could have made this kind of statements like, with 90% probability, we are sure that PNG will lose no more than, let's say, $20 million over the next week. But we don't know what's the maximum, but the minimum is 20%. So if the top management is given this kind of statements, the top management maybe would rethink that why are we taking so much risk. But neither this kind of statements were made, nor this. So obviously, since this approach was never taken, this kind of statements were not sent to the top management, who were not totally aware about the potential risks in terms of quantity that they were susceptible to. Again, another lesson for this was an overcomplicated deal, and this should have been vetted by the proper oversight committee or some top senior management. It doesn't appear that way, and the CFO was like made the scapegoat, so to speak, and he was sent on leave or something like that. And this much is sure that maybe the top management was never aware about the such a big risk that the company was taking. Another way this could have been avoided was, instead, so it is okay that these guys wanted to make money out of reducing interest rates, and they took the role of a put seller. So far so good, but they could have used the standard contracts which are available in exchanges like Chicago Exchange or others, instead of relying on a very specified or very, what should I say, customized contract. So, had they used those exchange traded contracts, then maybe PNG could have unwound their positions with lesser losses, since there was more liquidity because the contracts were standardized. Here, it was basically an OTC transaction between PNG and Bankers Trust, and once the spread has had increased to 15%, this put seller, which is PNG, was left with no option but to compulsorily buy at the increased prices, which is compulsorily take on the risk of the increased interest rate. It's just the same that happens to a put seller in the share market. Same thing was happening here. But had this contract been the standard contracts which were available in some CBOT or some other exchanges, then the losses could have been lesser, and due to liquidity, they could have unwound their position rather than. So, if they are unwinding their position, they are still incurring a loss, but the loss would have been lesser compared to the huge loss that they undertook, that they had to sustain when they when they had no option but to buy the higher interest rate from Bankers Trust. This is one way they could have minimized the loss impact, and that's pretty it about this use case. And overall, just keep in mind that we will this interest rate swaps are, it's not a very bad thing overall. Most of the banks are using interest rate swaps to hedge their balance sheet from interest rate fluctuations. This is a very critical component of duration management from an asset liability management point of view. It is also used extensively by various companies like PNG to reduce or at least hedge against rising interest rates. So it's not at all a villain, so to speak, but the way this deal was structured, it was not the correct way of using the derivative, and that's how things came to such a pass that PNG had to drag BT to court. So that is all about the use case. Thanks for listening to me, and we hope that you liked our video. In case you have any queries, do put in your comments or queries in the chat section, and do please consider subscribing and liking the video in case you found useful. And we will shortly come back to you with the next series in the FRM use cases, and this one was the fourth, and we will soon come with the fifth and the sixth series. Keep watching this space. Thanks.